So thank you everyone for joining us today. This is the session on credit markets, booms, busts, and distortions. And the central theme of our panel is how you can tell when credit markets are working for society. What kind of metrics you look at, what the goals are, what kinds of, how much you care about access versus, just sort of access and inclusiveness versus just aggregate growth of the economy, and that sort of thing. So I wanted to start by giving a brief introduction of our esteemed panel, who will then give, in turn, brief remarks to begin, and then we'll go into questions. So to my immediate left is Kat Taylor. She's the co-CEO of a community bank in California, Beneficial State Bank, which works on improving access to credit for more marginalized populations, as well as small businesses and individuals. And then Esther George, who is the president and CEO of the Kansas City Fed. And then finally, Claudia Buch, who is the deputy president of the Deutsche Bundesbank, the central bank in Germany. So we have two central bankers and one commercial banker, but sort of an unusual commercial bank. I will let Kat take it away with her remarks.
Thank you. Thanks very much. It's an honor to be here. Thank you, Drummond and Bob and others who invited us to be here. There wouldn't ordinarily be a bank here, I don't think, if we weren't trying to just expose what banking can be for society and why this bank is designed the way it is. It's actually held in the public interest. It is a nonprofit ownership structure, so that distinguishes a bit too. We're also a singing bank because we have to differentiate ourselves from the rest of the crowd. So bear with me. Oh, 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 you deserve a bank like this. Let me hear you say, oh, 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 we deserve a bank like this. So, sorry. I know I'm off, just off red eye, so I have a croaky voice. So we're very passionate about the role of banking in society. Banking is very, very important. When it's done well, it's very good for society. When it's not good for society, it's very, very bad. We took the time to learn from pioneering social enterprise banks like South Shore, Self-Help Credit Union, Grameen, Triodos, others, and really figure out what it is about banking that's so important and how we could design a bank that's sort of the 2.0 version of those. So essentially, banking is the first form of crowdfunding. It's matching the desires of our depositors with the goals of our lending activity. We're literally sourcing the funding for those loans from depositors, and what they care about should matter to us the most, in our view. There are structural elements of bank that make it very powerful. And I'm sorry, I don't mean to be pedantic at all, but I need to reveal how we think about banking so you understand how we designed our bank. First, banks enjoy leverage. They enjoy at least 10-to-1 leverage. That's the most conservative Tier 1 capital ratio that we adhere to. On the eve of the financial crisis, I think Bear Stearns was levered 33-to-1. Leverage is very powerful. It's exponential. And it's leveraging the lowest cost funding in the United States other than securitization, deposit funding, which is right now, receiving a very low return. It's also a recycling model. We sure hope that a very high percentage of the dollars that we lend out are coming back to us so that we can lend them again. It's an extremely measured model. We are regulated by the Department of Business Oversight in the state of California with reciprocals in Oregon and Washington, as we're a 3-state bank. We're regulated by the FDIC, from whom our FDIC privilege, insurance privilege comes, and also by the Federal Reserve, because we are a bank holding company by our ownership structure. And then it's also important to recognize that banking is complex. It's not very transparent by its very quantitative and technical components. And that means the average user of banking services is quite often not aware of what they're actually getting in the bargain. Often they're not aware until it's too late, until something is wrong and they have to go figure out how to fix it. So what do we do in our model to change the incentives to respect the various stakeholders of a crowdfunding model? The first thing we did was we gave 100% of the economic rights to a foundation of the same name, the Beneficial State Foundation, that qualifies as a public charity by virtue of its representation from Tides Foundation, Bridge Housing, and the East Bay College Fund. Those are rough proxies for community resources, the Tides is a large grant-making organization, for access to affordable housing and for educational equity. Those organizations appoint our board, a majority of our board. It can never be governed by any private interest. So it's essentially governed in the public interest. Moreover, you'll notice there's no private shareholder. There is no one for whom we need to maximize profit. We sure have to be profitable. Our regulators insist on that. And we know that no money, no mission. We can't even sustain our growth if we're not profitable. So you bet we are. But we target a 5 to 10% return on equity, not extraordinary returns that otherwise private shareholders might insist on. Then we recognize broader stakeholders. As I mentioned, our most important are our depositors. We're lending their money. They surely don't want us to lend their money to get the last coal out of the earth so we can despoil the air further, or to abuse poor people in poor communities with bad predatory lending or anything like that. We're pretty sure we know what they want to do, and we actually canvass them, and you can do that by offering branded deposits so you know what they want their deposit funding to support. Second, our lending commitments. We assure our stakeholders that 75% of our loan commitments at all times will be in the hands of the new economy. I don't know if this was a term kicked around already, but our definition of the new economy is fully inclusive, racially just, environmentally sound. That means our borrowers are affordable housing developers, sustainable food producers, renewable energy producers. They're also women and minority-owned businesses, social enterprise and B corporations, nonprofits. The other 25% can't be doing something bad. We try hard not to have it do something bad. If you think about that, that's a preponderance of loan capital going to install a new economy, not to reinforce the old one that's not serving us well anymore. We also adhere to a philosophy of returning consumer surplus to the consumer. We don't tolerate high margin products. Just because you can churn bank accounts for transaction costs, just because you can hide NSF overdraft fees, just because you can give the worst credit terms to low-income pre-prime borrowers doesn't mean you should. It's shocking that we give social license to corporations to do that. We don't do it. That's what constrains our return on equity, but that's what makes for healthy customers, healthy communities, and better business for us in the future. So our model is all benefit, no harm. You'll notice the no harm part. That's what's really different about us in the end. There are large divisions of the money-centered banks in this country who do every bit as good lending in the new economy that I just talked about. In fact, they're bigger, better, faster, stronger because they pull down public subsidy at an alarming rate that we can't compete for. Those would be housing tax credits, new market tax credits, et cetera. They're also among the most profitable divisions of those banks, but they are trailing behind them a train of misery as long as the state of California. It's the other stuff. It's not okay to do a little bit of benefit and a lot of harm. That's what's not serving American society in the way we have allowed banks to behave. I will talk, if in the question portion, because I'm mindful of that I should stop, about some other models we have. Thank you.
Great, thank you. So, Esther, I don't know if you want to open with an aria before you begin.
I have to say that was a first, Kat, and I'm not going to recommend it to the FOMC just yet as we take that on. But I want to thank Anat and other organizers today because I think this is a very important issue. This is an issue that, given what price the economy paid in 2008 and 2009, we cannot afford just to get generally right, that it pays to push into these issues. So I appreciate being part of this forum today. So this topic about credit flows and the implications as it relates to borrowers, I'm going to take back to a little more general level, kind of with my central banker lens on, because it is the role of our financial system to efficiently distribute credit. And getting the money from savers to borrowers is a very traditional function for our marketplace, and when that works well, it is beneficial. It allocates credit the way that benefits the economy best. And generally speaking, that requires two things. That requires that there is good information both about the true costs, the benefits, understanding the risk of that lending and borrowing. But the second part has to do with the incentives. And of course, that means that you reap the benefits, but you also pay the price when you take outsized risk, meaning that there is failure associated with that. So you definitely have to have the right incentives in place. And when you look at how the private market has done this, you see practices that try to overcome information and incentive problems. So you will see the private sector developing underwriting standards, and there are financial covenants that generally go along with borrowing. You see guarantees or sponsors signing on credit that help reduce the effects where you have limitations on information and adverse incentives. But as we heard last night, there is also a role for government in this space, and that is because, as Kat mentioned, there is a subsidy that comes through deposit insurance, a subsidy because of access to the Federal Reserve's discount window facilities. And so government plays a role also in making sure that those information and incentive problems are addressed. And so the issue of bank safety and soundness becomes very important, as well as consumer regulation, to make sure that the bank products are honest and fair and serve the public interest in doing that. So we've already heard today, and I'm not going to cover that ground again, about the efforts that governments and regulators have undertaken with regard to reforms, where those are targeted around addressing incentives. Those are well known, and they are very important as we engage in this discussion about finance and society. So there were two things that I wanted to highlight with regard to credit flows today that I think are critical, and I've heard some of it already today. One of those is the role of capital in the financial system. And I can't resist, with my central banker hat, to talk about the role of monetary policy and the role that it plays in those credit flows. Regulators, I think, on the topic of capital are going to have to lean much harder, I think, toward a bias of simplicity and transparency as opposed to complexity and opaqueness around rules. In fact, we look today at capital frameworks that are increasingly prescriptive. They are increasingly complex. And when you think about the focus of capital requirements that try to allocate risk based on risk weighting, the idea is you would get financial institutions to hold more capital against riskier assets. And in fact, what we saw is that sometimes those risk rankings can be misaligned. And we saw this in 2008 in particular, where, again, the risk weights focusing on mortgage loans, on sovereign debt, actually caused more assets to be focused in those areas, and it bore little relationship to the losses that were actually experienced at that time. So today, when I see the efforts that have been made, and I give great credit to those that are focusing increasingly on better quality capital, more capital. There clearly is more capital today than there was, but I think it misses the key point of whether it is enough and whether we have pushed hard enough to arrive at an appropriate level of capital. In that regard, I think pushing to look at what I call core capital, a leverage ratio, I think is going to be increasingly important. And when I look at resources that try to compare this globally, the FDIC has on its website something called the Global Capital Index, which strips out risk weightings to try to show in a comparative sense how the banking industry looks. And you will see quite different comparisons when you see that between sizes of institutions and across institutions. And so I think as we push on how to shore up loss-absorbing capital in the system, pushing toward very solid and durable kinds of capital is going to be increasingly important. Let me turn to my second point, which has to do with the role monetary policy plays. I understand this is not a conference about monetary policy. I won't drag you into this, Claudia, in talking about that. But it is clear that monetary policy, I think, and there's a growing body of research around this, about the important role that monetary policy plays in affecting risk appetite and risk premiums. And indeed, when we look at the monetary policy actions of central banks, zero interest rates for a prolonged period of time, using large-scale asset purchases, we know that if pushed for an extended period of time, these create vulnerabilities, and there could be long-run consequences for the things that we really care about: price stability, employment, sustainable growth in our economies. And so these are unique challenges today when you look at how credit is being allocated and consider where the risks are in the system. I will just say briefly that whether or not misallocations, certain risks have reached the point that they represent excess, that they represent bubble, that is always murky territory. But we know that asset values and credit growth, by the time it does rise to a level of concern where everyone thinks they can see it, you've generally waited too long. It is far more difficult for regulators to address that, and it certainly puts monetary policy in a more difficult position in terms of smoothly unwinding. So the reforms, the challenges ahead for regulators around making sure that credit flows in our economy are sustainable and beneficial to the economy, face some real challenges right now, both in terms of whether we will provide the capital needed to achieve that, as well as have a monetary policy environment where we can consider the vulnerabilities to be neutral overall relative to the growth we're going after. So, thank you.
Claudia?
Yeah, thank you very much. And thank you very much for inviting me to this conference. It's really very stimulating, very many new ideas also coming up. And I would like to give, it's actually very complimentary what I have to say to what Esther just said. I would like to bring in a little bit also the European perspective, because I think we've seen very interesting developments on European banking markets with regard to the evolution of credit over time, and then in the end also to discuss a little bit where we're going now. We have now the banking union in Europe, and we're also working on a big new project, which is the capital markets union. So this is kind of the framework of my discussion. And at the end, I would also like to give us a little bit of a warning in terms of that we now seem to know exactly where we have to go and what we have to do, but I think we also have to always step back a little bit and assess what we are doing and give a good policy evaluation. So I think this should also be part of our reform package. But let me start actually relating to what has just been said about the crisis, and just give you a few stylized facts on where I think we stand. I think there's lots of evidence that the crisis has led to a persistent decline in output. I think this is something we've always make ourselves aware of. This is why we're engaging also in this regulatory reform project. And it's not only that output has declined significantly in countries being affected by the crisis, but we are also seeing ourselves, and that's particularly an issue in Europe. I think the deleveraging process has been much more rapid. In the US, we still have very high levels of debt, private debt and public sector debt. We've done also, as has been mentioned before, we've come a long way in terms of addressing the issues, changing the regulatory framework. We had a big stress test and comprehensive assessment of banks' balance sheets in Europe. Capital levels have increased, but at the same time we still have high levels of non-performing loans on banks' balance sheets, in particular in the countries that have been affected severely by the crisis. And that means, coming to the topic of our discussion here, that means that banks have a hard time supporting the restructuring of the real economy that is needed. So banks burdened with legacy assets from the past, of course, have difficulties adjusting their lending portfolios and going into new sectors. So I guess the overall question that we are asking ourselves, and it seems to be the underlying issue here, is why is it that debt can become excessive? And nobody of us knows exactly the threshold level where there's too much of a good thing, but we've certainly in many regions, many sectors, we've moved beyond the point where an increase in credit would be good for economic development and prosperity. And that, by the way, is interesting. If you look at the literature that we've all been working with in the past years, usually we took credit over GDP as a sign for the development of the financial system, and now we've learned that we have to revisit maybe also some of our old empirical studies using credit as a sign for development of the financial system. So there are many explanations why there are these nonlinear effects, why at some point too much credit becomes unhealthy, so to say. And it's actually interesting to see that, to reflect that against the experience that we had in Europe. So one explanation is that if banks move from retail to wholesale funding, then they become more exposed to shocks from markets. And this is kind of aggregate view. When you go to studies, for instance, on the Spanish banks, but I think similar studies can be done on many other countries, you notice that the banks that went from retail to wholesale funding were most heavily exposed to shocks from international financial markets. So that's one of the mechanisms. Then there's also one explanation why is it that credit can become excessive is the move from corporate to private credit. I think this has been an issue in some European countries as well. Less so in Germany. When we look at the evolution of private sector credit relative to GDP, it's not very alarming. A third explanation is changes in the employment pattern in financial institutions. You all know these studies looking at what has been the talent that has been drawn into the financial sector here. I know there's a lot of studies on the US. I'm not aware of similar studies for Europe. And then that's a point that's actually interesting when you reflect it through the European glasses, and that's distortions and public sector guarantees. So that's also a reason why we have had too much credit in many instances. And there again, if you look at empirical studies, you see a lot of evidence that how distortions in the corporate governance structures of individual banks have affected lending to the real economy and have created some of the problems that we are now seeing. And we have lots of studies for Germany. I think the Landesbank now is almost a household name, and there was changes in the guarantee structure of their liabilities that induced them to engage in international lending. But there's similar studies for other countries, for the Spanish cajas. I'm not sure there are more Spanish speakers in the room probably who know how to pronounce it. So the reason why I'm mentioning this is not to pick on individual business models or to pick on individual banks, but I think it's important to remind us that these corporate governance issues are important, and I'm not sure that we've embedded them in a full-fledged way in our regulatory framework, because it's very difficult also for the supervisor to decide what's a good business model of a bank. I mean, this is something where you don't really have a good metric for it. A couple of words on what we are currently doing in Europe. I'm not going to talk much about the banking union, which was a big project to harmonize supervision over the large banks at the European level. I think it's very much needed because we have a common monetary policy. I think we also need a common regulatory structure, not only in terms of the rules. The rules are the same for everybody, for every country anyway, but also to have oversight over the risks that are potentially emerging. And I think one aspect of the banking union has gone a little bit unnoticed, and that's the recovery and resolution mechanism. So now we also have tools in our hands that we can use to deal with risks that have materialized. We have the bail-in tool, which in principle is a tool to also increase private sector risk sharing, a mechanism we didn't really have before the crisis, or not in the context of dealing with distressed banks. But the banking union is only one part of our big reform project. It's, for example, it's not changing the regulation, so it's just harmonizing the regulatory structure. But it wouldn't deal, for instance, with issues like risk weights on sovereign debt. This is yet a separate issue. Having said this, and then the banking union is a very comprehensive project. If you talk to people who are actively engaged in, the supervisors, they're very stressed by the stress test. But I think we have to go beyond. We also have to go under this capital markets union project. I think I just want to highlight one issue that I think is important in that regard, and that is going back to what I said earlier. We still have high levels of non-performing loans on banks' balance sheet, and dealing with that is very difficult in regulatory systems, legal systems where you don't have good insolvency legislation. So one aspect of the Capital Markets Union is also finding ways of how to deal with legacy assets and how to improve upon insolvency regulation, which doesn't mean that we want to have the same regulation across European countries. That certainly wouldn't be feasible and it wouldn't be good, but addressing these issues is important. Maybe if you allow me just one small final remark.
Quickly,
Yeah.
yes.
Yeah, quickly, because I mean this is something a message I also seem to read out of the discussion this morning. We are doing many new things in terms of the regulation, and at some point in time, I think we're also going to step back and say, well, maybe we can do it simpler. And so I just want to advocate a bit that we also have a good infrastructure for policy evaluation and really testing what we are doing and finding out what the effects are. And I think a lot more can be done. So maybe we can come back to that also in the discussion later on. Thank you.
Thank you. So Esther, I wanted to pitch the first question to you, which is what are the general characteristics of a well-functioning system of credit? I mean, what are the metrics on which we should be gauging whether a credit system is properly functioning and is serving the population that access it well?
Well, I suppose ultimately your benchmark for that is a growing economy that is checked by a supervisory function that is testing on behalf of the public how sound an institution is, to know that that's sustainable over the long term. So in terms of the data that we look at, I mean, we can look historically at trends of loan growth. We can look at the categories of where banks are lending. And I think to my earlier point about judging whether that capital, whether that credit is being allocated to its best use, relative to the frameworks that we put in place that may incent allocations based on risk weightings or other incentives that regulators create. I think that's the balance we have to test around whether we have gotten those incentives right. Because if you push too far in one way, and I would argue under Basel II, we pushed hard on misaligning essentially emphasis on mortgage credit that historically had looked safe in a way that caused a lot of correlation there. So those are the lessons that I think we have to take away and learn, that for sustainable growth in the economy, that credit has to flow to its best use, and there has to be checks on the system that let you know that that's being done in a safe and sound manner, and that it's being allocated to consumers on a fair and clear basis to them.
Claudia, what do you think about that? And the question being, what are the characteristics of a well-functioning system of credit? And to what extent do you think that the answer to that question might be different from country to country or culture to culture? I mean, one of the things that in the United States that we focus a lot on, or those of us in the press, but also elsewhere, is accessibility of homeownership, for example. The American dream is a big deal here. We have a much higher homeownership rate than Germany does. So do you care as much about what mortgage rates look like or how accessible homeownership is? To what extent do these principles transfer from country to country?
Yeah, so home ownership and the development on the real estate market is actually a very good example, not only of showing the differences between the US and Germany, but also differences across European countries. So you have very different models for home ownership. So I wouldn't say that Germans are not interested in owning a house. So this is also, I mean, to some extent, it's also been a policy goal. So there has been tax incentives for home ownership, but certainly the share of equity that people bring into those purchases are higher than in many other countries. So there's a tendency to first live in rented houses or rented apartments, and then only later on, once you've acquired sufficient equity, then to move into your own house. So this is, of course, also, I think, not that much different from other countries. But this is certainly these kind of differences we have to take into consideration when we look at the regulation of the financial system and whether or not we want to regulate the real estate market, whether or not we need macroprudential instruments to deal with risks on the real estate market. So we've been looking at this very closely in the Bundesbank and also with our colleagues in the German Financial Stability Council. You can read a lot in our financial stability report. The situation in Germany is such, for the reasons which I've just explained, that real estate loans are not growing very, very fast, so we don't really see a big issue here. We also see, we did a survey to see what LTV ratios are, and we don't really see excesses there. So from that point of view, the situation doesn't seem to be very risky. We also haven't seen large increases in real estate prices in Germany compared to many other European countries. So this is why the regulatory approach we're taking in Europe is that we have the European Systemic Risk Board, where basically everybody gets together and discusses issues and also tries to find a common framework for macroprudential policies, but then countries implement their own instruments. To some extent, the European level can go over and be beyond those instruments, only for specific instruments though. But in general, the macroprudential policies at the national level, precisely for the reason that you mentioned, that we have very different legal systems, very different cultures across countries, and that has been taken care of also in the regulatory framework.
Kat, to what extent do you think the quality of a country, of an economic system's credit system should be defined by the access that the most marginalized populations have to capital markets?
I'm glad you asked that, because I'm sure you're wondering how we're going to knit the two conversations together here, which is really important that we do, right? Because they're talking about essential macroeconomic policy that will drive all sorts of results and assure the stability and safety of the system. Very clearly the top agenda item. But then there's what happens on the ground. And I would say that credit allocation is essential. And one of the things that's making credit markets not clear and adding perverse incentives and system risk is a over-focus on the volume of credit and not enough focus on the pricing of credit. So there's no doubt that low-income communities and pre-prime borrowers are getting debt. Debt has addictive properties, not just to the borrower, to the financial institutions who sell it. Debt pricing is very, very addictive. The housing bubble was created not only by low doc and no doc lending that increased the total number of mortgages, but by pushing consumers to the more expensive mortgage pricing, which inherently increases the risk of default. Because as soon as you have a rising interest rate market and you have prime plus 3 instead of prime plus 1, you have a borrower you have more of those borrowers going to teeter in that than would if they had proper pricing. So I want to give one example of a current looming bubble, which is auto lending. Biggest auto lender in the country, operates very well in California, very, very profitably. FICO scores are a factor in here as well. And so I'm going to tell you that the large money center bank I'm talking about that does auto lending has created a perverse incentive, which is that dealers who can add rate or packages split the profit that produces. So if a auto borrower qualifies for X as a rate by their credit parameters, and the dealer can sell them a loan at X plus 4%, they keep 2%. If they also add an insurance package or a warranty package or whatever else, they keep the profit associated with, because that goes right into the main financing, right? We work with an auto lender who is very, very reputable and responsible. And they lend to borrowers who, by their FICO score predictions, meaning where their FICO score predicts that they should default 35 to 40% of the time. If anybody thinks that FICO scores predict ability and willingness to repay, this lender is producing results of 3 to 5% default. So to me, the difference between a predicted outcome of 35 to 40% default and an actual default rate of 3 to 5%, notwithstanding we haven't been through the rising interest rate market yet, so maybe they'll start edging up towards those, is a finance charge. It's a finance charge on the poorest people in California. It's very profitable to lend that way. So I think that the macroeconomics needs to address not only credit cycles in terms of the amount of credit, and it's interesting that we've stumbled upon the nonlinear curve, that there is such a thing as too much debt. So an advanced economy may not be defined by ever-increasing debt compared to GDP. I think growth as a sign of health also has the same nuances. What kind of growth? Is it sustainable? And the industry that's ahead of us, ahead of the banks on this, is the fintech industry. They are trying to find these market imperfections and create products that actually don't overcharge margin because they're going to take market share. The problem is they will never get access to the low-cost funding we have unless they essentially become like a bank themselves. And they can do that, but they have to, that is an extreme privilege to have that FDIC insurance. It is arguably one of the greatest privileges in America, and there's a lot of responsibility that comes along with it.
So sort of pivoting off of this, Esther, to what extent do you believe that distortions in credit markets might be driving or related to trends that we've seen in inequality in income, wealth, opportunity, that sort of thing? And what role does policy potentially play?
Well, the role of policy as it relates to monetary policy is to try to have your economy grow at a sustainable long-run rate, and to do so with stable prices. So the outcomes in an economy, and when you talk about inequality, these are long-term trends. And these are not the aims of monetary policy to adjust for these, but we know that that has been a long-run trend. Some people have argued that the nature of policy, so the focusing on large-scale asset purchases, which was by design to push into riskier assets, to influence asset prices to some extent, was successful in doing that. It might also be argued it has contributed to some of the ongoing differences that you see depending on who owns that wealth relative to others. So monetary policy is blunt. It takes a much broader focus, and it really then comes to the actors and the financial system to allocate that. And again, as we've been talking, depending on where your incentives are, you will get there.
Can and should, I should say, a central bank try to target those, try to better target its policy so that it allays concerns about exacerbating inequality? I mean, does the Fed or do other central banks have the tools available to even take that into consideration, and should they?
So by targeting, central banks, at least in the case of the U.S., are given their mandates by public authorities, which say, in the case of the Federal Reserve, over the long run, you're to look at sustainable growth, which will be measured by things like how employment looks, how stable prices are. Those are the aims of policy, which have to be for the long run. There are these short-run things, and my comments mentioned, when you look at a policy rate where it is today, it can have distortive effects in the economy, and that will affect the price of credit. It will affect the hurdle rate at which borrowers qualify, and it will also have consequences, as Kat mentioned, when that policy changed. So striking for a long-run neutral effect on the economy that allows the economy to work is the aim of policy.
Claudia, I'm wondering if you wanted to weigh in on any of this. What role central banks should have?
I mean, one answer is a very simple and straightforward answer. So the policy goal for the European monetary policy is very clear. So it's targeting an inflation rate close to but below 2%. So there's no room for, and I think there shouldn't be any room for other policy goals that are related to inequality or anything like that. So Esther just said it. I mean, it's the interest rate or the other instruments that we're now using, being close to the zero lower bound, are not targeted instruments. And I don't know. I'm not aware of any model or theory that could tell you how you could possibly do it. So I think this is beyond the question whether or not central banks should be aiming at these equality issues, because they're long term, they're structured. So having said this, of course, it's extremely important that the topic of our conference is finance and society, that we also think about issues related to inequality. We've had very intensive discussions about this, both domestically and across Europe, because we have high levels of unemployment. I think in the end, issue of inequality needs to be dealt with, the educational system and all these issues. So this is where you get probably the biggest long run benefits if you're starting educational improvements early on in lifetime. Having said this, I mean, your previous question was related to differences across countries. I think also here it would be very difficult to have this one-size-fits-all policy implication, because we have very different also fiscal systems and social security systems that are redistributing income. So I think all this has to be taken into consideration. And I think this is a discussion which is, of course, everything in the end is related, but it's not a discussion that we should be having under the heading of monetary policy and changing targets or anything like that.
Mm-hmm. It is one of the consequences of having central banks having been so prominent during this period, some even argue activist, is that people began to perceive many things can be solved by policy. And I think to Claudia's point, there are other factors, other policies that influence many of these issues.
But it sounds like there are concerns about the ways in which the blunt instruments available might distort decision-making about the kinds of, about the way that capital gets allocated, that it's not just that you're trying to sort of stimulate the economy more broadly, but within the economy, you're distorting some decision-making. And I'm wondering if these are concerns that keep you up at night.
Of course. So just as the goals are to stimulate, I hear regularly from people that say, for nearly 7 years now, I have not been able to invest in a safe instrument and get a return. So in an economy, when you use a blunt instrument, you will have uneven effects, and particularly when you see a prolonged period. All of these factors come in to helping a policymaker understand what the economy is responding to. My point was monetary policy cannot be the answer to all of these issues that we see that affect our economy broadly.
So if yes.
But of course, I mean, this is also a reason why we are considering low inflation to have positive effects, because we also know that high inflation has many distributional consequences. So this is, I mean, it's not like monetary policy is something completely separate from these issues, but the discussion we were having was about should there be an additional target for monetary policy, and that I would clearly reject. And of course, the issue about monetary policy and low interest rates and what are the effects on risk-taking, those have partly been discussed also this morning. Of course, they're very relevant, and what distortions this can imply. But that's also a separate issue that countries also answer differently, and to what extent they want to take these financial stability concerns into consideration as a goal for monetary policy.
Kat, so we've heard objections to using monetary policy, or reservations, I should say, to using monetary policy about trying to solve some of these other questions about financial inclusiveness and inequality. I'm curious what you think it would take to get the private sector to take more of an interest in, making affordable credit available to low-income and, frankly, higher-risk people, right? I mean, most banks are not willing to give very low-interest loans to people that they perceive to be very high risk, and there are potentially some longer-term consequences of that for those individuals in terms of their ability to start a business or make rent or whatever else. Are there ways to incentivize the private sector to step up and provide more opportunity short of just direct subsidies?
Thank you. So they're perceived. They're actually, it's not factual that low-income people are a worse credit risk. It's quite the opposite. And that my FICO example was supposed to be some demonstration of that FICO scores are not only not predictive of credit loss experiences very accurately, they're not very accurately predictive. They're also triple damning, because now FICO scores are not only used by banks to price credit, they're used by landlords to rent housing and employers to offer jobs. So that's a scary thought to me, that at a time when income disparities are worse it's ever been in the United States, when it has installed deep financial and political incumbents and made people poorer, we're now going to give them the triple whammy, where they're their fates across the most critical activities of their lives are going to be determined by an inaccurate predictive tool. A little known fact in predatory payday lending, for instance, is that while payday lenders may harvest FICO scores to rationalize giving the worst price and term to a vast unsegmented market of pre-prime borrowers, that's the way to maximize profit. They do not report any borrowing behavior, positive or otherwise, into the bureaus. So they are withholding from the very rating agencies that are supposed to tell us about the credit risk of individuals the information about their payment history that could change the predictive outcomes.
So if I'm understanding you correctly, you're saying that banks are leaving money on the table by not being willing to lend to people that are not actually that high risk.
No, they're lending to them at extremely overpriced products. They do it all the time. Big banks are lending either through investments in payday lending or cash advance products that have the same onerous credit pricing as the others. It's not that. They're not allowing the markets to segment into efficient pricing, which would give more people the pricing they actually deserve. And remember, in finance, it's not like selling bananas or housing or something. It's when you sell somebody a credit product that's too expensive, it increases the risk of default in the future for non-substantive reasons, for overpriced. At the peak of the economy before the crash, financial services represented 25% of GDP. Remember, with all due respect, and I'm one of them, bankers don't do anything. We do not do anything. We only push money around to let other people do something. So that is way too high a finance charge on the American economy. And it's installing this income disparity and accelerating in ways. I want to say, though, that I think that I totally agree with what the panelists are saying about monetary policy, what its proper goals are, what its dynamics and opportunities are, and what it has to do. It's just the causation is the other way around. It's not that I'm arguing monetary policy should solve for these things that we see happen over and over again. These things happen over and over again, and they affect the financial system way more than the policy. So the bubbles, those are real. That happens, and then we have crisis. And the re-regulation, I heartily agree that if we don't have the risk of failure held by those who deserve it, which are the shareholders of the bank, if it's held by the American taxpayer through the FDIC insurance fund, that's insanity. So we didn't quite get that done. We got some steps along the way there, but that's the way I think to right the risk. And then actually, two more things. There's extreme liquidity imbalance in the world right now, northern to southern hemisphere, and even within hemispheres, where, at least I'm told, in Northern Europe, for instance, some depositors are being charged to place their deposits, or the deposits are being declined because there's too much capital that has to be reserved against them. That happens in America. And some borrowers are now, because of the contract terms that they have in their loans, the rates are so low that they're actually getting paid to be borrowers, which is not maybe such a bad idea because borrowers provide a lot of value. And this is my last point. We need to redistribute wealth, or else we'll have these imbalances in incumbencies that won't let us execute on the right policies. And the way that it might happen is the silver lining of income disparity. A massive amount of charitable assets exists in the United States. Could we induce them to pay for performance of our borrowers? The most enduring market advantage you can have as an actor, a firm, is a lower cost of capital. Could we pay those borrowers who are producing affordable housing, renewable energy, clean environments, the absence of predatory practices, could we pay them for that performance in a way that lowers our cost of capital, makes them more competitive against their alternative competitors in the market, makes the banks who facilitate that lending more competitive, and changes the dynamics of who tells us what about what they're doing. Right now, we get a lot of financial performance metrics from companies and banks. We get virtually none about non-financial outcomes. And those are as important as the financial outcomes.
Esther, what do you think about this? I mean, not in terms of monetary policy, but in terms of your role as the Fed's role as a financial regulator. Do you think that the Fed as an institution has the tools available to try to incentivize the allocation of capital towards what Kat has defined as more socially beneficial uses?
So I think the job of the regulator is to ensure that financial institutions are well capitalized, that they are carrying out their important role in the economy. So this credit intermediation role, the maturity transformation process that they do, in a way that's sustainable. So that means the job of the regulator is to assess the quality of the assets that you're making decisions to lend against, to make sure that there is capital held against that underwriting is there, that the consumer protections that are inherent in making sure that credit is lent fairly. That is the purview of the regulator. Redistribution, I think, is not the aim of that. And so I think if institutions are operating in a safe and sound manner, and if you see those characteristics, then that suggests that the economy is getting access to the credit it needs at the price that represents the risk associated with that credit.
Claudia, many of my questions have been premised on the idea that we don't have enough credit, at least certain populations do not have enough credit. You, in your opening remarks, had expressed some concerns about excess debt, at the very least. What are the metrics that we should be using to determine when that is the case? I mean, how do we know that there's an excess of credit, either in the aggregate or within any one particular industry or sector?
Mm-hmm. Yeah, let me maybe, before I answer that question, but it's actually related to that, just have one word on the discussion you just had. And I would like to issue a word of caution. So just as we said, we don't want to overburden monetary policy with all other kinds of goals. I would also be very careful in overburdening the financial sector and the banking sector with, achieving all other goals we have in society. So there's many good political goals you can have, but I don't think it would be a good idea to through whatever subsidized lending programs you may have in mind, or some other incentive systems to induce the financial sector to fulfill those goals. And I think that would also be stretching the role of the banking system too far. Of course, I mean, we have all, as consumers, we decide which products we want to buy, and what price we want to pay for it, and then business models of corporates are more or less profitable, and the banks are lending to them. But this, for me, is the mechanism, and we shouldn't be having whatever subsidized credit programs or what else you might have. So coming to your question about how can we tell whether credit is excessive. So I think we will never have a very good metric for either credit being excessive, or when or where does a bubble build up. And I think we should also be also there a little bit more humble and not ask too much from our empirical model. So my starting point is actually always first think about incentives and think about resilience in the system. So resilience in the system, as Esther said, for me it's capital. Are there sufficient buffers so that if risks materialize, the system, the banks and also other financial intermediaries can bear these risks out of their own risk buffers. And the second is incentives, and actually what I just said about distortions we are sometimes building into the financial system in terms of subsidies, in terms of incentives where we're trying to give to certain for funding certain activities. This is part of the incentive structure, but it's also related to everything we discussed related to the regulatory system. So I think this is my starting point. So we can do all kinds of, and I think this is very useful, doing empirical studies, econometric studies, trying to find the tipping point where credit becomes excessive. That's one thing, and we have to do it. For me also, as a regulator, and thinking about how can we improve the system, it's really these two things, thinking about incentive structures, thinking about capital. Do we have enough capital in the system? That's much more, I think it brings us further ahead than trying to look for the, answer that precise question, where does it become excessive?
Mm-hmm. Kat, you're in the, oh yes. I was going to ask you a question, but
I just want to be sure nobody's confusing that I'm arguing for subsidizing credit products. I'm actually arguing for terminating the practice of overcharging in fraudulent ways for credit products. It's not what we need to do more of, it's what we need to stop doing in the banking system, and that shouldn't be a burden on the banking system. That's just cleaning it up.
So tangentially related to this discussion that we've had just now, there have been a lot of developments in the Bay Area in particular, trying to figure out how to better assess the risk of particular lenders through means other than credit scores, right? Gathering all sorts of other data points in the age of big data. I'm curious if you think this is a good thing in terms of access to credit, if this worries you at all, given that who knows what kinds of data points could correlate with protected classes or other issues. Basically, how do you see the rise of sort of the use of technology affecting many of these questions, use of technology in assessing credit risk and behavioral data and that sort of thing, affecting these questions about access?
So we're, as a bank, very, very engaged in this process and cautiously optimistic. There's no doubt that we can get better, smart machine learning analytics on predicting the ability and willingness to repay. Almost anything would do a lot better at this point. You're right to point out that the cautionary tale is how we do it, and that it be compliant with all the regimes that we deeply respect and hold as a member of the FDIC insurance pool. So fair lending is probably the one we worry the most about. We work with a company called Lend Up. It's an excellent company. It is providing fairly and transparently priced consumer debt. It's got a debt product called Ladders No Chutes. It literally is increasing people's FICO scores and access to credit. They use smart machine learning analytics. They're very wary of violating any banking compliance regulations, because if they did, they would no longer have access through us to deposit funding, which is very low cost funding compared to hedge fund debt or even securitization for this kind of activity. So they submit to all the fair lending audits that we do, the primary one being disparate impact. It doesn't really matter if you've been absolutely correct in how you underwrite somebody. If you have a disparate impact that affects especially protected classes, you're in violation, and they know that, and we know that, and we do a lot of auditing around that. They also have to be very careful of customer privacy, very important in the banking system, and highly related to data security. So they submit to all the same audits. In the end, I think they are going to set a model for how fintech can marry with banking institutions and produce a much better product for consumers that is sustainable economically and is compliant with all those very, very important regulations. So I'm keenly excited about it all. I just don't think we're done with banks yet, and that's why we run one.
Okay. So I think we can now open it up for questions. There are mics traveling around the audience somewhere. Right here.
Thank you. Want me to hold it? Oh, good. Hi, I'm Alex Bakawi from the Council on Economic Policies in Switzerland. We work on monetary policy and inequality issues, and I was therefore very interested in your discussion, and I wanted to come back to the mandate that you, Ms. Buch, mentioned, which I understand has price stability as its core objective, but I also understand that then this mandate goes on and says, without prejudice to the objective of price stability, the ECB shall also support all other objectives of the European Union. And if that is so, wouldn't we do justice to that mandate if we at least understood the impacts monetary policy has on these other objectives, including inequality? And to turn this into a practical question, would it be conceivable for you that the ECB helps us understand these issues by reporting on what they assume the effects are of their policies, for instance, on inequality?
Yeah, I can take this directly. No, I think the mandate is very clear, as I've just stated. So it's the objective of price stability. Having said that, of course, it doesn't mean that we shouldn't try to understand what are linkages between monetary policy and other policy areas or other policy outcomes that we think are relevant. So in that sense, yes, of course, we are looking into the impacts or there's research going on at central banks on the links between monetary policy and inequality, because it's not like something we shouldn't try to understand. But I think there's two different issues. One is the analysis, and one is the policy goals. And for the policy decisions that are being taken, there's a very clear set of indicators, and this is usually communicated. I think the communication is pretty transparent. And also there's a separate line which is doing the research, and I think also research is very transparent. So I think there's a lot of information that can be shared. But I wouldn't agree with your initial statement that there's also this broader policy mandate. I think this is what distinguishes us a bit from the US, where the Fed has a different also official policy mandate. But yeah, so these are these two lines, I think, which should be clearly separated.
Yes. Back here.
Hi, Marshall Steinbaum from the Center for Equitable Growth. I wanted to pick up where Alex left off about the impact of monetary policy on inequality. I mean, the dual mandate or even the single mandate are not themselves distributionally neutral. I mean, we have evidence that wage growth at different parts of the wage distribution is differentially sensitive to the unemployment rate, for instance, and to sort of say, oh, well, this is outside the realm of monetary policy making is to say, well, we are going to make policy that changes the distribution of income. We're just not going to say that that's part of our policy. And I would suggest it's not a matter of sort of adopting a third mandate in the set of mandates that the policymakers attend to, but rather to recognize that in some sense, and I think that some authors like Mian and Sufi have made the point very effectively that credit cycles that you're trying to regulate as policymakers are themselves the result of widening inequality, that the purpose of the banking sector is to reallocate reallocate capital from savers to borrowers, and the savers are the wealthy who have extremely high savings rates. The borrowers are increasingly people who have not had wage growth over their lifetimes.
Is there a specific question you want?
Yeah, well, I have a question for the policymakers. How would you incorporate the fact that the policies that you're making have a profound impact on inequality, and that inequality trends have an impact on the policies on what you need to implement as economic policy?
So my response to your question is not to argue that there are not distributional effects from the policy, but to remember that for the long run. So a policymaker thinking about what they influence in the long run, and the mandates given to the central bank from their political authorities, in the case of the Federal Reserve, are clear about long-run sustainable growth. Maximum employment, price stability are all part of those metrics. There are many elements that the central bank cares about, and I say care in the context of we understand many things influence the economy. But we also know, if you look at the FOMC's long-run goals and objectives that it affirms at the beginning of each year, it talks about where it can target certain things. For example, inflation has been targeted at a certain level. Employment has not been targeted because there are many other factors that play into the influence on that. And financial stability is mentioned in terms of factors that are considered. So in the range of tools that a central bank has to use, I think it's important to remember you focus them on the long run, that you not try to undertake more than what that mandate asks you to do, and you have to think about the long-run consequences. So when you think about issues that policymakers were concerned about in 2003, not unlike today, concerned about very low inflation, concerned about higher levels of unemployment, and keeping interest rates low for longer, over the term ended up costing the country more unemployment. And again, so being informed about how policy affects you over the long run, I think, is the lens with which policymakers have to keep in front of them in the scope of the mandate they've been given.
Right here.
Thank you. I'm Jennifer Lee with Hong Kong Phoenix TV. Question for President Lisa George. It's a follow-up question. So you talk about how the long-term low interest rate might impact. There are many impacts maybe on the financial stability. But at the same time, we see the United States GDP growth at the first quarter is just 0.2% and the job gain were slowing, but the FOMC think it's just a temporary. So I wonder, do you think it's appropriate for the FOMC to raise the interest rate after the June meeting until they're confident, that the indicators are moving towards the level that they're confident? Thank you.
We're now getting to the bottom line of credit allocation, aren't we, and all of that? What's the interest rate? The committee was clear, I think, in its statement that it is going to continue to look at the data as it comes in, that makes each meeting a possibility for raising interest rates, and I have been very public about my own concerns and preferences for normalizing policies. So.
Thank you. Right here.
Before I ask my question, I'm struck by how narrow and siloed our definition of inequality is. It just focuses on finance and economics. But as Larry Summers pointed out on this stage, or another INET stage last year, the price of virtually every non-politically inflected product or service, as he calls them, has declined over the last 20 years. It's only education, healthcare, and what's the third one? The ones that are controlled or influenced or inflected, as he calls them politically, that have. So if you look at the increase over the last 20 years, everybody has enjoyed improvements. The best example is the cell phone that's accessible to everyone now and would have been available only to the very wealthy 20 years ago. That indicates an increase in equality in terms of quality of life.
So what's your question for our panel?
2 questions, thank you. First of all, what is the net gain or loss in the number of banks in the US? To Kat's point, the more banks we have, the more competition there is. That would seem to address some of the concerns that she raised and make the overall system more resilient if we had more banks competing with each other. So that's one question. And 2 is, doesn't a uniform regulatory regime across the entire US introduce its own systemic risks? Wouldn't it be better if we had 50 different regimes that were tailored to each state's exact requirements, and which further let the states observe from and learn from each other more rapidly?
Okay, so it sounds like the question is sort of at its core about competition between regulatory systems and between banks. Is that a fair characterization? Anybody want to take that on?
So let me take your last question just to say in the US we have what we call a dual banking system, which does allow state chartered institutions as well as federal. So you have 50 states who have banking laws and regulatory authority, and those get combined with a federal overlay, whether it's through the FDIC or the Federal Reserve, and how that state regulation is calibrated. So that system has worked in terms of, you look over the long history of the dual banking system, innovations have come out of that, competition. Your question about what's happened to the number of banks, that has been a steady decline. And you have seen that most rapidly over the last decade, particularly since the change in Glass-Steagall, when we went to Graham-Leach sobriety, creating more universal banks. You have seen systematically market share shift to the largest players in the United States. And with subsidies that come along with that, you can expect that that market share is going to continue to shift unless there is some, and Dodd-Frank attempts to do this, some taxing that happens on that that begins to level that playing field. So we have 6,000 banks in the country, but heavily concentrated around a handful of banks.
In Europe, there's actually been more movement towards harmonization of financial systems, right?
Yes,
Rather.
That's right. Yeah. So it's actually, I mean, this is a little bit the European experience that I alluded to. We had, of course, national responsibility for banking supervision across the European countries in the framework of a common market for capital. So harmonization of the regulations that apply to each jurisdiction. But up until the banking union, the power to supervise the banks was at the national level, and that has changed. So we are, again, the banking union doesn't change the regulatory framework. That has been harmonized through the capital regulation directive and all that. But now we've centralized part of the supervision of the banking system to the single supervisory mechanism. So to some extent, we're going into that direction of making it more centralized, which also means that the same standards are being applied across countries. We have so-called joint supervisory teams that go to the individual banks and that apply common standards across countries, which legally has been the case before. But of course, we have very different legal systems across countries and legal origins and legal traditions across countries. So I would also, I mean, this is a little bit the last point that I made. I don't think that in Europe we should be harmonizing everything, because we also have very different corporate governance structures that have been working well across countries. If you compare the growth rates across countries, it's not so clear that one corporate governance system works better than the other, and this is closely linked also to the legal system, of course. But we have to keep watching, and we have to check what are the regulations that we do have to harmonize, where we are introducing disincentives into the system. Of course, this is something which is still a big project, and this is ongoing. Yeah.
Go on.
Just out of our own personal experience, we started out as an OTS bank, an Office of Thrift Supervision. There was consolidation of the federal regulatory regimes. OTS went into the OCC. We became an OCC thrift. When we were looking to see what charter we should take, it was clear we weren't going to qualify as a thrift anymore. We had to become a bank. That's when we looked at the state regulatory regime. And the reason we chose the state was that they have a dual mandate: safety and soundness of the financial institutions, health of the California economy. So under the second mandate, we have a lot more alignment for the things that we're working on, like an alternative to payday lending, which is not something that's preferenced in the federal regulatory regime because of a more linear focus on safety and soundness. And it's kind of scary to think about offering that. I think over the 10 years, we went from about 12,000 banks to 8,000 by the crisis, 8,000 to 6,000 now. You'd think that there'd be still enough competition, but it is true that I think 95% of the assets are held by 10 institutions or something. It's very lopsided in its distribution. And there's a scale to banking. The regulatory and systems and other overhead of banking is quite high. So actually, community banks have been quite underscale and have had a very difficult time attracting capital and recovering from the recession because of being subscale. So that we actually need a little more consolidation, in my view, in the community banking level. But it's very difficult to get the same sort of competition you might expect in other markets when your product is actually something that the consumer has to apply for and get approved. It introduces, to me, another factor that doesn't lead to market clearing as easily as it might in other commodities.
Right, way in the back there. I think this is probably our last question.
First I'll say having cell phone doesn't necessarily mean that inequality is better, because the rich people can now go into space now, which they can't even think about past 20 or 30 years ago. So I believe inequality got worse, and inequality is a long run issue, because it is an emergent consequence of consistent ill-motivated behavior in financial markets, because financial markets is 25% of debt covers 25% of GDP. So I wonder if there's any, you guys have idea that how we can govern or guide their behaviors in the market, so we can educate them to have I would say better behavior or fairer behavior in the market.
Anybody want to take that on?
We're trying through competition, but it's pretty ridiculous for me to say that. We're 530 million in assets. Bank of America is 2 trillion in assets. So we're not even a gnat. But it's important that we begin. And So I think it's important that we capture the imagination of the American citizenry about how important banking is, and that they get to vote through banking. They literally get to vote by where they put their deposits. That $2 trillion number is a little disturbing too, because the Veterans Administration, I think, is $69 billion, not a B, not a T. It's very hard to manage organizations that big. Just manage, much less have some accountability to society and the communities that they serve. And I think the reason we keep coming back to that is this conference is called Finance and Society, and we're to asking people who have very hard jobs governing the financial system to also govern for societal ends. And I'm not suggesting it's easy at all, but the last 40 years to me is evidence that we're going to have to solve for that bigger problem.
Thank you.